Good morning, everyone, and welcome to today's webinar, A Beginner's Guide to Investing in 2021. My name is Teniola Kolawole, and I'll be your host for today's session. I work with the origination and client experience team here at Quantum Zenith Asset Management, and I'm excited to be hosting today's webinar. Before we get started, I have a few housekeeping items I would like us to cover, both about the presentation and about the Zoom webinar platform. Firstly, can everyone hear and see me properly? If you're having any issues hearing or seeing me, please go to the comment section and put your issues there so that our technical team can attend to it immediately. Secondly, the video is going to be available on demand. It will be sent as a link to your registered email address. Today's webinar will be a discussion between myself and my colleague, Mr. Adetumi Atayero, on the subject matter, and then we'll be taking live questions after the session. Now, please feel free to drop your questions in the Q&A session in the Zoom app, and we'll attend to them. For any reason we won't be able to attend to your questions, be well assured that we'll attend to those questions after the webinar. Now, without further ado, let me introduce my colleague and our speaker for today's webinar, Mr. Adetumi Atayero. Okay, so Mr. Adetumi Atayero holds a first degree in economics from the prestigious Covenant University. He is a level 3 candidate of the CFA program. He has over 12 years experience in the financial services sector, covering equity and fixed income investment research, portfolio management, core banking, and treasury operations. Let's make welcome Mr. Adetumi Atayero.
Thank you so much.
You're very welcome. Okay, so usually at the beginning of every year, we usually get quite a number of emails, calls from clients and prospective clients making inquiries about what investments they need to do in the new year and just generally asking for what guidance we can provide in terms of investments. Now, we at Quantum Zenith Asset Management have decided that, you know what, let's put all these questions together and attend to those questions with this webinar. I promise that you will definitely enjoy today's webinar and there will be one or two things you can pick up from it. Now, let's just go straight to it. Mr. Adetumi Atayero, welcome again and thank you for joining us today.
Thank you, Tony.
I have a few questions to ask you, but before we get started, there's no how we can talk about investment for year 2021 and we wouldn't look into what happened in year 2020. Year 2020 was a spectacular year for everyone. It was a pandemic year. It was a year where we saw a lot of volatility in our markets. So firstly, I want you to run us through how the financial market in 2020 performed.
Okay. Thank you again, Tony.
You're very welcome.
I'm pleased to be here. So if I'd like to give a theme for the financial markets in Nigeria in 2020, it would be excess liquidity. And it was a holdover from the policy of the CBN in 2019 on the homo securities market. So just a brief background on what that was. So in October 2019, CBN came up with a policy that only deposit money banks and foreign investors will be able to invest in homo securities. So that had an instant impact in the market as maturing homo securities hit the system, and there was no other place to go other than fixed income markets assets available like Nigeria Treasury bills as well as some other money market instruments. So that was what played out throughout 2020. There was a lot of liquidity, a lot of money chasing after fewer securities, fewer investable securities. And so that had significant impact on yields in the fixed income space. And just to give you, to put that into context, but beginning of the year, average yield in the fixed federal government of Nigerian bond market was about 11%. By the end of the year, was about 6%. And a similar thing was experienced in the Nigeria Treasury bills market as well. Beginning of the year was about 4.85%, but close of the year 2020, it was doing less than 1%, which was quite a significant drop. And to put that further into context, we want to compare that to what inflation was doing last year close at about 15.75%, which meant negative real return for most investors in fixed income space last year. Similar thing played out in the equity market, but this time around, it was for the benefit of the equity space. And how do I mean? By the end of the year 2020, the Nigerian equity market, Nigeria Stock Exchange, was one of the best performing in the entire world, returning over 50% as measured by the all-share index. So that was really spectacular performance, but what really drove the equities market was the excess liquidity, as like I already mentioned. So you had a lot of maturing obligations in the fixed income space, chasing down yields in the treasury bills and FG bond market, and then some flowing through to the equities market, and then boosting prices of stocks in that space as well. So basically, that was the major theme for the Nigeria financial market in 2020. A lot of downward trajectory in terms of yield, and asset prices being inflated when you talk about the equity space. So that was what we experienced. And yes, so I can just give an overview or like an outlook for 2021 based off of where you're coming from. So beginning of the year, we're already noticing a slight uptick in yields relative to where we ended 2020 at. It was only expected. It was expected because from where we were coming from, like I said, NTB yields were below 1% in 2020 as of December. There was no further to fall. It only had, markets, the general consensus in markets was it was time for a rebound in yields. And the last auction, both in the primary market, treasury bills, as well as federal government bonds, bear witness to this because there was a slight uptick in yields in those auctions. And generally, that's what we expect to play out, at least in the for the rest of the year. Just to put the caveat, we do not expect yields are going to get back to where they were in 2020, in terms of beginning of 2020. Double digits, or even 2019. I mean, if you look at Nigeria Treasury bills market, there was a time in the not too distant past when we used to do 18%, 16%, 17% for the 1 year Treasury bill. But right now, those feels like a long time ago, because what we're doing right now, it's hovering about 1%, 2%. So that's where we are at the moment. But as for expectations for the new year, we expect yields are going to pick up just slightly, because we're not going to have the same thing play out in 2020 in terms of excess liquidity. There's going to be a moderation in the maturities that are going to hit the system in 2021, reducing demand for investable assets, and then moderating prices. So we're going to, to just speak to equities market, we expect, at least for Q1, we expect to see a boost in prices continuing, although not anything remotely close to what happened last year. And the reason for that is, for the first quarter of 2020, we're going to still experience a lot of liquidity in the system, but it tapers off as we go through from Q2 to the end of the year. So expectation for dividends is another factor that is going to probably boost interest in the equities market. You have some very good names at very, very tidy dividend yields that could interest market players to look at those stocks. So I'm going to have that as well play out. But if I was to make a prediction for where the equity market will end at the end of the year, I'd say it's going to be an appreciation, but nothing as exciting or as outstanding as what we experienced in 2020. So that's just what I'd like to say about that.
Thank you so much to me. Thank you so much for that review. Thank you for the outlook. Now, seeing how the outlook looks for year 2021, what would you think, what investment options do we have available in year 2021? What should we look out for? Where do we begin in terms of investing in year 2021?
All right, thank you. Since the webinar is targeted mainly at beginners, I'd like to address my response appropriately. So for 2021, in terms of investment options to look at, I'll start with maybe mutual funds.
Okay.
And that covers both fixed income space as well as equity space, as well as equity proper as an asset class.
Okay.
And just to break that down further, so under mutual funds, you could have a money market fund, which invests basically in Nigeria Treasury bills, as well as commercial papers of corporates. So that's what you have there. Usually, what I'd advise is money that you do not intend to keep for too long, just something to invest in, short-term investment, basically. That's what the money market fund gives to you. Then you can have the fixed income fund or bond fund, as the case may be, which invests primarily in federal government of Nigerian bonds, and then that's for investments that are longer term in nature. So you're trying to save for retirement, save towards retirement, you're trying to save towards a project, funds that you do not intend to use in the short term.
Okay.
So that's more advisable to invest in that, because when you compare the returns in the fixed income or bond mutual funds to money market funds, it's quite the difference is quite significant.
Oh.
For context, last year The average in mutual funds, fixed income mutual funds was about 8%, thereabout, while for
Money
money
market
market fund was about just a little over 1%. So that's the difference that you have there. Thirdly, still speaking on mutual funds, okay, you can also have the balanced strategy funds. What these try to achieve is diversification within the same portfolio. So they have exposures to both equities as well as fixed income securities. That's what you have in the balanced strategy fund. And lastly, you could also have USD mutual funds, dollar mutual funds, and that's very, very important. I mean, it provides a hedge against Naira. So last year, in the review, I didn't mention, but last year we had a series of devaluation of the currency. For context, in the beginning of the year, we had parallel market rate at about 360. By the end of the year, it was about 470, 465 thereabout. So that was significant devaluation in the currency. So you just want to protect your assets or hedge some of your portfolio, some of your investments by investing in dollar mutual funds. And there are different houses that provide that investment opportunity. So it's something you might want to consider. So that's on the one side. The other side as an asset class is equities as a standalone. So there are two ways to do this. You could either invest directly through a stockbroker. I mean, picking stocks that you want to invest.
Like cherry picking the stocks.
Yeah, cherry picking stocks based on some fundamentals, or maybe it's dividend or quality of earnings or profitability. I mean, whatever metric you want to use. You could either do that, or you can invest also through a mutual fund vehicle. So that way, what they do is they take off all the old stress of picking the stocks, managing the dividends, the reinvestments. They take that off you, and they just pull funds together from different investors, and then they invest in equity stocks on behalf of a number of other investors. So that's basically what that is about. So I think that works. Those are the investment vehicles that you could want to consider for 2021. And an advantage that I would say is you should have a balanced portfolio, whatever you decide. Like I give an example of the market in 2020. So equities was up over 50%. I'm using the entire market as a benchmark, was over 50%. But the returns on mutual funds and money market funds were just slightly over 1% and about 7-8%, which I mean compared. So if you had investment in equities, you would have been very, very happy. And if you had investments in mutual funds, I mean, it was still something tangible. Although when you now factor in inflation, you are probably not as excited about the return you're getting. So so that's what you have in terms of investment options available. But just to go further and because we can say all this, but you're probably wondering, if I wanted to start now, like how do I go about it? Yeah, so so you could have what is called systematic investment plan, and it's nothing fancy. It's just setting aside a particular sum of money every month, every week, whatever the frequency it is you decide, and then setting aside a particular sum of money for investment. So you can do this through, if you go the stockbroker route or the mutual fund company route, what you need to do is maybe put in place a standing order such that every month or every week or whatever frequency you decide, a certain amount of money is debited from your account, transferred to the investment house, and then they make investments on your behalf. So this is very, very important, and you don't need to, you can start small, and that's the beauty of mutual funds. Even direct investments, you can invest for 1,000, for 10,000, whatever it is you have. You don't have to wait till you have ₦1 million to start investing. The most important thing is you have a plan in place. So you start small, decide the percentage of your salary or your income you want to invest, and then do it on a monthly basis. And then as the months go by, maybe you get promoted or you get other sources of income, you increase what you're allocating to your investment, because in the end, I mean, you have to be futuristic in your view and be thinking about what's going to happen in the future. So that's what you might want to also put in place starting today. And you can start immediately. So like I said, you can start with as low as 1,000 or 10,000. The important thing is you have a plan in place, and then you are sticking to that plan so that you can see through. I mean, this is January, so this is one of coming beginning of the year. So, and I mean, for most people, salary period has probably just come or it's around the corner. So you might want to put that in place starting now, and then by December, you want to review what you've accomplished so far in the year.
Thank you so much, Sumi. Thank you so much for that. So some things I picked, and I would just like to reiterate. We were asking about investment options, and then you talked about mutual funds and equity proper. And that mutual funds, you said there was money market investment,
Yes.
fixed income investment like bonds, and then we had dollar-denominated mutual funds. And then you said equities, that's you by cherry picking the stocks that you wanted. But then when you even spoke about that, you said it was for beginners. Since that's our target audience, it's better for you to use an investment company, an investment firm, and buy equity mutual funds if you want to do equities. Thank you so much. And something else that you said, SIP, the systematic investment plan.
Yes.
Just putting a particular amount aside every month for your investment. That's something, starting small was another thing that he said. Thank you so much to me. I really appreciate it. So now you've run us through the investment options we have in year 2021. What pitfalls should we try and avoid also in investing? Because I understand with investing as well, there are some pitfalls that might come with it. So what do we need to look out for in terms of pitfalls during this investing year of 2021?
Okay, yeah, so that's a very, very important question. So for 2021, we're talking about, let's assume these people are going to be invested for the very first time.
Yeah.
So it's very, very instructive to know the signs to avoid or the things not to do as you embark on your investment journey. So I just give 5 don'ts of investing. So I'll just call that, and then there are probably more, but I feel if you're able to incorporate these 5 in your decision making, it's going to put you in a very good stead for your investment journey. So the very first one I'm going to say is, don't invest in any business or any scheme you do not understand.
Okay.
That is extremely important. It's Warren Buffett, arguably one of the greatest investors of all time, that said, beware of geeks bearing formulas. And what he was basically saying was, when they start showing so much calculation and so much further math, and you're getting confused, just know that it's not for you. I'm talking about beginners here, so it's not for you. I took my time to explain what investing in mutual funds and equities are. Just maybe I can break that down further. So if you're investing in equities, for example, you're investing in units of a particular business. Yeah. So for example, you're investing in a Zenith Bank or a Nestle. You are investing in a company. When you go on the streets, there's probably a branch of Zenith Bank close to you. Yeah. In your household, you use products from Nestle. Yes. So these are companies that you're investing in. So you're a part owner. That's what investing in equities does, actually. You're a part owner of a business, of a thriving, profitable business with a lot of history. So that's what equities investing is. And if you're investing in fixed income securities, mutual funds or money market, whatever the case is, you're investing in federal government of Nigeria's bonds. Yeah. It's as secure, it's as safe as it comes. You're investing in maybe corporate bonds as well of some blue chip companies. Thank you very much. So that's another opportunity. That's another option you're looking at. So the things that investing in, you can point at them. These are entities that you know about, that you interacted with in one way or the other. Yeah, so it's easier. So that breaks it down. But then when you now start hearing of certain investments that you just have to be very careful, because you don't want to invest in something that you do not understand, because so usually the more complicated the investment scheme is, the higher the chances of you losing money. Yeah. That's what I've come to conclude in my experience. So I just want to, if they cannot explain it to you and you understand it in simple layman terms, then it's too technical for you. Then if I put your money in, you might as well, know the risk you are taking. Yeah. So basically that's it. Do not invest in businesses or schemes that you do not understand. Another thing is, don't get carried away with promises of higher returns. So that's one mistake people make, both beginners, intermediate and advanced investors. They just come dangling return in front of you, and you just, the saying that if it's too good to be true, if it sounds too good to be true, it usually is, actually comes to play here. So we are in an economy as we are. I've already described the various asset classes, and if someone comes to meet you that, okay, there's this investment, if you put in 10,000, you're going to get 25,000 in a week. And this is not far-fetched. People get these messages and people are enticed. But then you have to think about it, like, what kind of business could anybody possibly be doing that guarantees that kind of return? And so that's where people get carried away and they lose their money. And another thing people do not realize is risk and return are two sides of the same coin. So yeah, you can't. So let me break it down. We're looking at investing in Nigeria Treasury bills, for example. I told you it's about 1% now. But guess what? You know that if you wake up tomorrow and you want to get your money, guaranteed you're going to get it.
Yeah.
So that means you're sure about that.
Yeah.
So that's why. So you're getting a lower return because of the guarantee or the safety of the instrument. So that's, I mean, it's risk and return. So you're taking no risk basically by investing in government security. So your return is guaranteed. The higher you go in terms of return, the higher the risk becomes. And so, okay, I told you equities last year yielded 50% all share index for the year. The year before, it was 15% negative, thereabouts. Wow. So that's volatility. Volatility is a measure of risk. There's no volatility involved in investing in the Nigerian federal government. If you invest in January and they promise you 2% return, forget it. By the end of December, you're getting a 2% return and your principal. But for equities, it's not the same. You can invest, the price can go up, it can come down, you can do so many things within a year. So by the end of the year, you could either be losing money or be making money. So you are getting exposure to higher return, but immediately at the same time, you're getting exposure to higher risk. So the higher the return promise, the higher the risk you are taking. Just take it from me. It's law of finance, it's guaranteed. You can't tell me you want to get a return of 50% or 25%, and you're not willing to take risk that's commensurate with that level of return. So you can't, anybody promising you anything different is just deceiving you basically. It becomes luck when they're promising you higher returns at low risk. And I have personal friends that have lost a lot of money, different schemes or different promises. I mean, give me 5 million, I'll give you 15 million in the next year. How? What are you going to do with the money? What could you possibly be doing? Just know if you are putting your money into such schemes, you know the risk you are taking.
Yes.
That's what I just like to say that. I mean, it's fine if you've calibrated your risk level and you decide that this is something I'm willing to take a risk on.
Yeah.
I mean, it's fine. Or just know that, just be aware of the risk you are taking. Basically, that's what I'm trying to say. And then so, I mean, avoid Ponzi schemes. I mean, except you're the one starting the Ponzi scheme. Otherwise, it becomes a case of what is called greater fool theory, which is you are investing in something that you know is going to bust, but you're just hoping that it's not my turn, that it's going to scatter. As in, let me just enter and come out. But I mean, we've had the MMMs of this world. We have so many schemes in the past, and people have gotten their fingers burnt. And so, just be careful. I mean, don't go chasing yield to the point that you get careless and then you get wiped off. So that's very important. So that's the second one. Don't get carried away with promise of return. Another thing is don't pay any attention to market fluctuations. And this is very, very important, especially for equities investing. And so, I mean, to make it practical, last year, at the height of the pandemic, or when it started, about March, April, thereabout, GTB share price went as low as 14 naira 85 kobo or thereabout. Zenith Bank was about 11 naira at the very depth of the bear market in 2020. I mean, when prices were really, really going down. And today now, GTB is about 33 naira. Wow. Zenith Bank is about 26 naira thereabout. Wow. I mean, that's within how many months?
That's less than a year.
Less than a year. So people that got really scared when the pandemic hit. And so what I try to tell people is, I mean, it's good to have the right perspective. So when there was pandemic in 2020, what changed for Zenith Bank? Did all their branches disappear? I mean, it was a global pandemic affecting everybody. Yeah. So you don't act out of fear. I mean, that's one thing Warren Buffett says. And I might quote him a lot because, like I said, he's probably one of the greatest investors of all time. What he said was, we get fearful when people are greedy and get greedy when people are fearful. Which, I mean, so you could imagine when Buffett in the Nigerian market last year, when equities were really down, he would have been licking his lips, looking at Zenith Bank at 10 naira, 85 kobo, looking at GTB at 14 naira, looking at Nestle at maybe 800 naira. I mean, so many stocks were down, and people were just sell. I want to get out. But guess what? Between then and now, what has changed for Zenith Bank?
Nothing.
Practically nothing. What has changed for GTB? Practically nothing. So the business is still fundamentally sound. It's just a temporary issue, but the market reflects. I mean, the market is a manic depressive, based on what someone said. It just fluctuates some days for no reason. You can just wake up today, Zenith is 23 naira. Tomorrow it's 12 to 21 naira. The day after it's 18 naira. I wonder what's going on. Sometimes for no reason whatsoever that I can point your finger on. It's just the way of the market, and it's not peculiar to the Nigerian market. S&P 500, which is the benchmark for United States, the biggest stocks in the United States as well. It's the same thing. You go to China, it's just the nature of the equity market. So my advice is, if you're going to do this on your own, invest in equity markets, and you're picking stocks, you want to pick quality stocks with high profitability, good history of even paying dividends, so that you can easily accumulate wealth. And then once you make you do your research, you take position in these stocks. Don't bother about what the market is saying. As long as there are no fundamental changes in the market, in the company rather, let the market just do what it wants to do, and just invest there and go to bed. Don't go checking your phone every day, looking at Zenith is up 2 naira today. You're going to have high BP doing that. Market is always, it's a characteristic of market to fluctuate. It's what it does. So if you're investing in equities, take position in very good stocks. If you're investing through a mutual fund as well, or through an investment firm, take position in stocks and just go to bed. Don't bother about the daily fluctuations. It doesn't help. It just makes you do things that you... so last year, there were people that sold at 10 naira, let's say Zenith, for example. People sold that stock at 10 naira, 85 kobo last year. Some of those people are probably buying back today now at 26 naira. That's not how to build wealth. You don't buy when it's expensive and sell when it's cheap. You do the reverse. You buy when it's cheap and sell when it's expensive. So you buy low, sell high. If you do the reverse, you're not going to be making wealth. You're going to just be losing money in the market. People just be ripping you off, basically. So that's what I saw a video, a funny video. So the guy invested in Bitcoin. So he was saying, when he saw the price going up, he was buying. But then the price started going down. Then he was like, it's going to tank. So he started selling. Wow. Then next thing he knew, the price started going up again. But he felt so he waited a bit. Then he started buying when it started going up. Then it started going down. So basically it was chasing, don't chase trends in the market. You can't win. Don't time the market. You do not, nobody has a crystal ball that tells them where the market is going to be in the future. So you just want to, the way to mitigate your risk in equity investment is invest in solid companies. Like I gave the example of the bank and the fast-moving consumer goods company. Take positions in those type of companies and stay there. The best you can do is when they pay dividends, reinvest. When it gets cheap, buy more. Another thing that really boggles my mind is, how do you decide any bank is good for you to hold at 26 naira, but then it's no longer good for you to hold at 10 naira? So it's just temperament. People are not able to really just calm down and have the will to just see through whatever the cycles are in the market. Yeah. So that's another very important thing to bear in mind. Another thing is what I call, don't interrupt the magic of compounding. So compounding is sweet and it should work for you. It's one of the easiest way to build wealth when you talk about compounding. Basically, I'll just give an example. So you invest 1,000 naira in January and it's a 10% return. So in December, you're going to get 1,100 naira, right? Yep. So if you reinvest that money, you're not going to be getting interest on 1,100 naira. So that 100 naira on top of the 1,000 is going to get its own interest. Yeah. Then the 1,000 is going to get another interest. So by the time it comes to the end of the second year, you're going to be reinvesting on the 1,100. So you're going to really start compounding. So that's the magic. That's the beauty of staying invested for long periods of time. You don't need to do anything. It's like magic. It just does its thing. So you can invest 10,000 in 2000. By 2020, it's already maybe 8 million or 500,000, depending on what rate of interest you're getting. So you have to bear that in mind. But so why this is practical is maybe you have a fixed income investment with the bank, for example, and then it's supposed to be for a year. The tenor is 1 year. By the 8th month, you go to break it. You're actually short-circuiting the process, and in the end, short-changing yourself, basically, if you think about it. So that's very important. Compounding is, it's like magic. I can't emphasize that enough. And the beauty is, you just invest, make the initial investments, and leave it. And it's not limited only to fixed income investments, even in equity market. So you get dividends, instead of spending it, reinvest, buy more with the dividends you're getting. That way you're increasing your stake, as the company is growing, becoming more profitable, your share of that profitability is also increasing, and then you are building worth. So that should be the goal for everyone. I mean, building worth, not just frittering everything away in the short term. Lastly, it's an advice: don't be in a hurry. I mean, it's Buffett again that said, you cannot get a child in 1 month by impregnating 9 women. You still need to wait 9 months.
Yes.
Some things take time. If you want to build wealth, it takes time, which is why I said don't get caught up in all these fanciful schemes that promise you all sorts of return, and then you get burnt in the process. It takes time to build wealth. Buffett that I keep referencing, he didn't start today. He's had so many years, and he will tell you. I mean, there's success in investment or in investing has more to do with temperament than with intellect. You don't need to be extra smart. I mean, it's just very basic things that you need to do, put in place, and you're going to be able to increase your wealth. And so the most important thing is you have to be very patient. You have to stay invested. So that's why it's important not to follow fluctuations. Just stay in the market. As long as you're investing in the right types of securities, you're going to come out laughing at the end. And Buffett would also tell you that one of the greatest advantages he's had as an investor is time. The fact that he's been able to do this over and over again for so many decades, that in itself is an advantage, which also links back to what I said about compounding. The more you stay invested, the longer you stay invested, the higher the chances you're going to grow your wealth. So, I mean, it's like the thing about someone planting a seed today and then going back to dig it up to check every other day. It's not growing. You're not going to go that way. You need to leave it there. Keep watering it. Just keep it there for as long as possible, and then eventually it's going to sprout, and then, I mean, becomes a tree and bears fruit. So that's it. I mean, so temperament is very important. Stay in the market. Don't chase trends. Don't try to time the market. Nobody can time the market. The market sometimes dances to its own tune, especially the equity market. They'll tell you it's a random walk. Today, it's up. Tomorrow, it's down. Sometime for no apparent reason. It's just the way it is. So those are the pitfalls I think new investors should avoid. And if you're able to do this, it's almost guaranteed. I mean, all things being equal, that you stand a better chance of building your wealth and creating more wealth following this than any other thing.
Okay, thank you so much, Tony. Thank you so much. I think some of the things that I picked were you shouldn't invest in any business that you don't understand.
Yeah, that's very important.
Any scheme, any business you don't understand, because it's already looking complicated. Won't go near there. So I should not be in a hurry. That's another thing I picked. So thank you so much. Thank you so much. I think you really brought it down to our level, to truly beginner's level. So thank you so much. All right, now having heard the pitfalls that we should try and avoid in terms of investing in year 2021, with how the state of Nigeria is and how our disposable income is being eroded, what practical steps do we need to put in place to reduce our expenses, that's to cut down our expenses, so that we have enough money or enough income to invest? If already our incomes are already being eroded, we wouldn't have enough money to invest. So what steps do we need to take to cut down our expenses so we have more money to actually invest?
All right, thank you so much. That's a very, very crucial question. Some of the first things you hear when you tell people, because I engage people on this issue of investing and building wealth, and some of the things you hear is, I don't even make enough right now to survive.
That's true.
And you could take that as an excuse and just leave it there. But the truth is, even from what you have, you should be able to save and invest. So it's a matter of priority, if you really think about it. So if it's more important for you, for example, to splurge or to drink 3 bottles of beer, for example, or to engage in any other excess, than it is for you to invest. And so it's a matter of preference. It's a matter of priority.
Yeah.
Exactly, that's the word, priority. So you have to prioritize it. But I'm not discounting or discarding that saying that. We have barely enough to survive on. It's actually true. If you look at inflation, and I did touch on it earlier, inflation as at December was 15.75%. Food inflation was about 20%, over 19.5, 19.6% thereabout. And that brings it home. And I was sharing with some of my colleagues a while back that when I was younger, when they talk about inflation, I just think about, oh, Nigeria's inflation is 10%. Okay, and just be on my way.
You can't
But I couldn't relate. Like, but now, I mean, when you have bills to pay and when you're the one, when you're, I feel the pinch now. Like it's, so I go to buy something today, and in a week's time, I go back and they tell me it's now up by maybe 15%. And you have some cases where some of the companies did not want to increase the price. So they reduce either the quality or the quantity of what they're selling at the same price. Because, I mean, they have to get by. They have to be profitable. That's what the whole idea of a business is. So, I mean, it's legitimate observation and reservation. But having said that, you can still do it.
You can still cut your
You can still cut your expenses. There are some places you can still cut fat and then be leaner in the way you manage your affairs. So I'll just give some tips. The very first one is you have to have a budget. That is the starting point. And having a budget, I mean, it's fantastic. It does a lot of things for you on a personal level as well as on a financial level. Okay. So immediately when you have a budget, so what's the budget basically? It's you just saying from now to the end of the year, or if you want to break it down on a monthly basis, every month, this is my income. These are my expenses. I mean, taking time to sit down to do that already puts you on a path to financial well-being and success. Just taking that time to really sit down to account that first. I mean, so that's the biggest thing about budgeting is discipline. It instills in you a sense of discipline, and it's even easy for you to be disciplined when you look at your income and look at your expenses and you're like, okay, I've been running deficit budgets like Nigeria for the longest time. And what's the deficit budget? Basically means your income is lower than your expenses, and that's no way to live or no way to build wealth, and it puts you under constant pressure. You do not want to have that. So you have to sit down at the beginning of every month. It's best to do this beginning of the year. If for someone that works in a salaried employment, and you know how much you're getting per month, and if you have other side businesses as well, you know how much comes through. So on one column, you have your income stated, and on the other column you have your expenses. So when you sit down and you do your budget, and immediately it becomes clear to you that, okay, there's a problem. I'm living beyond my means based on what you observe immediately from the budget. So that immediately tells you something has to be done. So that's one thing. So the discipline it instills in you is very, very important, and it spills over into other areas of your life as well. And so that's one thing. You have to have a budget. I mean, when you have a budget, it's almost like an eye-opener. You see immediately the state of your financial affairs, and then you know right there and then that I have to do something. This cannot continue, and so you have to put things in place, and then I mean, you try to improve your financial position and then have a plan. So when you do the budget, you realize all your expense heads, and in terms of which ones you have to cut down on, so that you're going to be able to increase your income to be able to invest. I mean, there are two ways to make wealth, and companies also use this as well. Two ways to increase your income. It's either you're cutting costs, or you're increasing revenue. So those are the two major ways. So I mean, as a salaried employee rather, you might not have a say on when it's going to have a salary, a pay raise. You know what is coming through to you. That's what you can plan with and work with. So you work with that, and so you're trying to maximize that income and minimize your expenses such that you're going to be able to be in the green by the end of the month. So that's very, very important. So either increasing your income streams, or if you have to live with what you have, then you have to minimize your expenses. So that's one thing. Another thing you can look at is that I mean, you have to live within your means. I mean, the old saying, cut your cloth according to your cloth, comes to mind. According to your cloth, that's, I mean, emphasis on cloth. According to the material you have, that's how you should cut your clothes.
Not according to your size.
Not according to your size. According to your cloth. So if you do not have, if what you have is not enough for 3-piece, do buba and shikoto, don't sew agbada. I mean, whatever practical steps you need, because this is a very practical steps you have to take for you to be able to cut down on excesses. And I mean, I know it's a cultural thing with all these ashwebis. You have people spend so much on ashwebis that they do not get to wear again. You might want to pick how many ashwebis you can afford in it, especially because some of these clothes you can't get to wear them again. I mean, I'm not going to break it down to you. It's up to you to now sit down and look at your expenses and decide for yourself, what do I need to cut down on? And then you make that cut and you reduce you reduce it. And someone said, if you buy things right now that you do not need, eventually you're going to sell things that you need. I mean, so life is in stages. Men are in sizes. Live your stage per time. You do not really need to use iPhone 24 now. You don't really need to buy bone straight hair now. I know that's the age. I mean, PS5 is out. It's been the age of social media. Boyfriends looking for girlfriends that will buy PS5, and I mean, it's funny. But if PS4 is still working, use PS4. I mean, because if you think about it, there was PS1, there's PS2. It will stop at PS5.
No, it won't.
It's going to keep going. I mean, they're going to keep collecting your money, and these are just expenses that, I mean, if it's really, really serious, you have to pay, go to a game center. Maybe later after the COVID has gone. But whatever you need to do, practical steps that you have to take to cut down on your expenses, you have to do them. I mean, we did mention on inflation. I mean, you're just staying on your own, mind your business. Inflation is doing damage to your income. And then, so that's on the one part. The other part, you're also now spending excessively, or things that you can cut down on, or things that, if you cannot afford it now, then you cannot afford it. Wait till you can afford it. And if you can afford it now, can you afford it in multiples?
Yeah.
So the fact that I can buy, I mean, so you don't spend your salary, for example, in a month on a phone. I mean, personally, I still use iPhone 8. iPhone 12 is out, but I'm not bothered. I mean, because there's no catching up with these things.
So.
It's just and all of us now have the privilege of coming from I mean, very, very wealthy backgrounds. We have to, I mean, start up by ourselves, try to put things together for ourselves. So, I mean, if you're in that list, if your surname is not Dangote or $10, or I mean, if it's something you have to really think about before you can buy it, then it should give you pause. Like just, I mean, someone talked about a 24-hour rule. Before you spend on anything substantial, use a day. I mean, don't just go into spending. Use a day to really think about it. Do I really need it? What are the pros? What are the cons? Like, can I afford it? If you cannot afford it, then delay it. You have to learn to delay certain things so that you can enjoy later. Another thing is you have to manage your subscriptions. I mean, especially the foreign ones. This is something I try to, I mean, pay attention to personally. So you have, you're subscribed to Apple Music, you're subscribed to YouTube Music, you're subscribed to Spotify, Only You, Tidal as well. I mean, if you're not in the music industry and it's not your core role or function to, I mean, how many songs do you want to hear? Yeah, if it's just a hobby or something for a pastime, don't spend too much money. I mean, Apple Music is enough. It has over how many million songs? How many can you listen to in a year? So, I mean, be sensible, be wise, cut down on things that you don't need, things that you can do without. The same thing goes to, I mean, some people have Amazon Prime, Apple TV, HBO, Showmax,
Netflix.
I mean, you shouldn't even spend so much time watching TV, I mean, so that you can be productive in other areas, but I mean, that's just by the side. So we're talking about cutting down expenses. So if you can do without it, if it's not extremely important, if it's just a nice to have, not a need to have, then you need to cut down on it. I need to, or get rid of it altogether, as the case may be. Another thing you have to do is you have to be disciplined in your spending. It's very, very important. And this talks to delayed gratification. I mean, so in economics, the very first things you learn is human wants and needs are insatiable.
Yeah.
They are quenchless. You cannot. Today now there's iPhone 12. Tomorrow there's going to be, later this year, there's probably going to be iPhone 13. So you're going to want that as well. Yeah. So your wants, they're like weeds. They just keep sprouting up, keep growing, keep growing, keep growing. But the resources you have are not infinite. I mean, you cannot afford everything you want to have in this world. I mean, speaking for the general people now, not for the 1%. You cannot afford everything you want to have in this life. So you have to learn. Another thing we learned in economics, the basics is scale of preference. So you want to rank your needs so that you're able to identify the ones that must-haves, that are essential. Yeah. Those are the priorities. You want to highlight those ones, and as you go down the list, you start crossing some off, at least in the short term, so that in the future you're going to be able to enjoy some of these things. I mean, a counter argument would be this YOLO sentiment: you only live once. That if I die now, I mean, I hear people say this to me all the time. If I die now, the next of kin will enjoy my money. Just enjoy your life. I mean, spend, splurge. I mean, that's an argument. But the reverse is, there's something else called longevity risk, which is the risk of you outliving your resources. So you are planning you're going to go at 40, and then you end up at God decided to now bless you with long life. He says you're not coming yet. Stay till
So
you're
you want to
1 cent, or you're 80 or 90. Or fortunately for you, you did not do your research, and in your family you have, I mean, very, very lovely genes that people live to very old, So, and you've done YOLO in your youth. It now remains that you're going to now cope in your old age. I mean, if you have to manage, it should be now.
Yeah.
So they can have a comfortable retirement, comfortable old age. And this is the time to save. Because the older you get, the shorter, I mentioned the effect of compounding.
Yeah.
The older you get, the lower, the shorter the tenor or the time you have for you to do compounding.
Yeah.
So by the end of your year, in your 60, 65, 70, you don't want to be working then. You want to just be chilling. Yeah. I mean, traveling with your wife, golfing. And you don't want to be under pressure at that stage of your life. This is a time to hustle.
And you also don't want to like be a burden to your
children or to your relatives. Exactly. I mean, I do not plan for that. So you want to be, in fact, you want to even give them. You want to have enough and access to spread to your coming generation. So that's very important. You can either manage now and enjoy later, or enjoy now and manage later. So I mean, you have to just make some decisions now. And think of the kind of lifestyle you want to have in the future. I'm not saying you should now go, I mean, the rage now is Stingy Men Association of Nigeria. I'm not saying you should become a member and be stingy to yourself. I'm just saying cut down on excesses. Limit the things that are not essential, cut down on them for now. I mean, maybe you're able to advance your career and become very wealthy, or able to start your business and you build your business and become a household name and become very wealthy then. But there's a season for everything. There's a time to plant and a time to reap what is planted. So this is the time to sow. And especially speaking of people that are still younger, just starting out their lives. So the born straight hair, the iPhone 12, those are not priorities. They're just things. It's just consumerism culture that we have. We just want to buy. I mean, investments is treated as if it's an afterthought. It's not really important. But the reverse should actually be the case. So you have to be disciplined in your spending, save as much as possible, invest as much as possible, so you can have a comfortable retirement or a comfortable old age. Lastly, this might sound a bit drastic or draconian or even primitive, but research has proven that if people actually spending cash, it puts a check on them than just swiping a card. So what I'm going to advise is maybe you want to go cash only, or what is called, you can use the envelope method. So beginning of the month, having done your budget, you are now going to decide, okay, 20,000 naira goes to an envelope for transportation, 25,000 naira goes to an envelope for feeding. I mean, you could do this physically, or you could do it using a wallet. There are apps that you can actually use for this as well. But I mean, it's a thing, and I've proven it personally. If I have to spend cash, I feel more reluctant than just swiping a card. I mean, I don't know why it's that way. It's a bit of mental accounting and psychology. That you literally feel the impact of what you are doing. Like, imagine having to count out 250,000 naira for an iPhone 12 that you know you do not need. And I mean, it's different. It's different how you feel than just maybe swiping a card or just doing a transfer. So, I mean, that's really drastic. And depending on where you are in terms of discipline and how you're managing your finances, it's something I want to look at. And the envelope approach as well, that really helps because so you've made your budget. So by the time you have spent all the money in the envelope for feeding, for example, and it's not even half of the month yet, you already know you're going to be in trouble for the month. Or maybe for generator fuel. I mean, it's really difficult these days, if we're being honest. And with the hike in electricity tariffs, PMS price keeps going up, devaluation of the currency, we're having inflation going up. I mean, so this is even more reason why you should take active steps, be proactive, be deliberate in how you manage your finances, and then cut off excesses, cut off the fat, and be lean. And then manage accordingly. So you might want to look at the rent you're paying. Can you afford it? Those that are married, the school your children are going to, is it the one that once it's time for school fees like this, high BP? There are schools that are within your budget.
And are also good.
And are also good. I mean, you hear, I want my child to go to St. Saviour's because of networking. I mean, it's fine. It's a good thing to aspire to, but if you cannot afford it, don't go and put yourself into debt, put yourself under a lot of pressure to do things that you cannot afford at this present point. There are people that went to schools I've never heard their names before, and they are PhD holders, are doing very wonderfully well. And so it's sometimes not where you start, it's where you end up. So you might want to just look at that school fees, look at I mean, rents, where you are living, can you afford it? There are places in Lagos that you can afford if you have to move. Because it might seem drastic. Because another thing you have to look at is they usually say you should have enough savings that if you should be able to maintain your livelihood for 6 months if you were to lose your job.
Yeah.
So if you are barely stretching, barely able to afford what you are doing right now, if you were to lose your job, what now happens? You can't manage. It becomes a very total change of lifestyle. So you have to look at so many of these things and then decide for yourself what is more important. Impressing my neighbors, impressing my colleagues. Camry drives as well as Benz. Camry parts are cheap and easy to. If you have a Benz, it's fine. It drives different. Trust me, I know. It's not. It's literally not the same, but it moves it from A to B. So what is the priority now? To get from A to B, or to get from A to B in the utmost luxury, which you cannot afford. I could go on and on and on and on about this, but I think my point is made. Cut down expenses that where you can cut down, so that you have enough to be able to invest, and then you are investing for the future. Live as comfortable as you can now, but don't be lavish. Don't be. Know what you're doing, and then it puts you in a better position for the future.
Thank you so much, Timmy. Thank you so much. This was very personal. So thank you so much. One of the things I took have a budget. You talked about how if you buy the things you don't need, you also have to spend the things that you need. That quote really got to me. So yes, be disciplined, manage your subscriptions. And then you said that the whole you only live once, so spend
everything.
What if you then don't? So yeah, so I learned that as well. Thank you so much to me. With everything we've already covered, actually we've covered almost everything I had written down. We'll just take out time now for our live questions, the questions that we have. So please feel free to start sending in your questions so that Tumi and I can start talking about those questions. Thank you again, Tumi. I really appreciate it.
Glad to be here.
Okay, welcome back. So we've gotten quite a number of questions. I'll just go to the first question I'm seeing here. Someone sent a question asking us that with fixed income securities yielding negative returns currently, and we have inflation with over 16%. The same thing with treasury bills doing below 1%. What investments are available for us to hedge inflation?
Okay. So like I said, the trying to limit this to the scope of the webinar, which is investing for beginners in 2021. When I was delineating the different asset classes earlier, I mentioned mutual funds. You could have dollar mutual funds. You could have naira mutual funds, fixed income mutual funds, money market mutual funds, and equity.
Yeah.
So I think the two classes that might help with the inflation thing would be the dollar mutual fund, as well as equities. So having exposure to those two go a long way to help hedge against inflation. I have to put out the caveat that there is no guarantee that equities are going to do remotely close to what they did last year. 2019 was a bearish year in terms of the equity market was down 15%. 2020 we're up over 50%.
Yeah.
So it's a very, very risky asset class. But basically, if you're trying to hedge inflation, that's one of the asset classes you have to look at.
Yes.
And then the dollar mutual funds as well, because if you have that hedges both currency risk as well as inflation risk. I don't want to get too technical, but I'm knowing the inflation problem we're having in Nigeria.
Yeah.
So having investments in another currency that inflation in America has been below 2% for a while now, relative to over 15% in Nigeria. So that helps you to, having exposure to that currency through a mutual fund investment in dollars helps to
you
minimize your exposure to inflation and
Okay.
hedge inflation.
Right. So to me, thank you very much. So to me, mentioned the equity mutual fund, and he mentioned dollar funding, dollar mutual fund investment. So if you want to know more about those investments, just contact an investment management company so they can explain the nitty gritty of these mutual funds to you. Okay, we have another question. This person is actually asking concerning the equity market. So he says that the equity market did over 50% last year. His simple question is, was that backed up by any fundamentals, or was it a bubble? Was it a fluke? Like that increase that I enjoyed last year, was it backed up with any fundamentals?
The short answer is no, because basic economic theory would have you believe that in a recession year, equity is an asset class you want to avoid.
Okay.
Because basically it means businesses are not performing well. And having equity investment is basically having an investment in a business, like I said. So if the business isn't doing well, then the unit of that business, which is what a share of a business or a stock is, should not do well as well. So it should reflect the performance of the business. But 2020 was a peculiar year in the sense that it was a pandemic year and there was a lot of liquidity in the system. So that was basically what drove investments. I mean, like the first question mentioned, it was negative returns mostly in the market last year. So I mean, it's something to see your investments actually going down, and you try to do something about it. And the next best alternative was the equities market, which was also a lot of funds going to the equities market. But then I should give some color around. I mean, when you just hear Nigerian equities market went up by 50% last year, it's not all the stocks listed in Nigerian equities market that went up. It wasn't even all the sub-sector indices. So we have consumer goods, we have insurance, banking, oil and gas indices. Not all those indices went up for the year. Consumer goods didn't do so well. Oil and gas didn't do so well. So it was basically the industrial sector that really powered the ASI last year. Try to just limit it so I don't get too technical, but just have a back of your mind that wasn't all the companies listed last year that went up, that did well. So that's why I was emphasizing you have to be very careful with the kind of stocks you invest in, and you have to, which is why you need an expert to really break it down, to you. So just have a back of your mind that 2020 was really powered by liquidity because people didn't have any other alternative where to put money in a negative yielding environment. So that was what was responsible for that.
Thank you so much to me. So we have so many questions. Let's just move very fast. So we have someone here, Tommy. She's asking, how do you determine solid companies to invest in? Please shed more light on foreign equity investments and indirect real estate investments. Thank you.
Okay. So let me start with the last question.
Okay.
That's indirect real estate investments.
Yes, indirect real estate investments, foreign equity investments. As you said, solid how do you determine solid companies to invest in?
Okay. So I'll start with the solid companies. It's not really rocket science. I mentioned Nestle and some bank names when I was discussing. Nestle because they produce products that we use on a daily basis. That's one thing. Another thing is you check their history. You don't invest based on what's happening now. You want to have some sense of perspective on how that company has fared over the long haul. So take a Nestle. They've been listed for so long. If you look year on year, the profitability has been very steady. In some cases, growing. I mean, so you want to look at profitability. You want to look at how strong the brand is. You want to consider, in some cases, dividends. Do they pay dividends regularly? So that's another thing you want to look at. Then their performance, how widely known their products are. There's something called MOAT, M-O-A-T, which basically means their competitive advantage or competitive edge in the market. So what in their sector, are they the dominant players or are they the second most dominant player? Have they been able to expand their the business? Are they growing? So these are the things you want to really look at to make a decision on where to invest. Basically, there's a dichotomy for equities, which basically brings it down to the layman term. You can have growth stocks or value stocks. So growth stocks are stocks that their expected growth rates in terms of profitability and earnings in the future is higher than the average for their sector.
Okay.
So these are stocks that are based on the life cycle or the maturity of the industry that they operate in. If it's a new industry or just with a lot of potential for expansion and growth, these are companies that operate in that sector are called growth stocks that have higher than average expected growth in earnings.
Okay.
And then there are value stocks, which basically means stocks that are usually more matured and they pay a lot to their shareholders in terms of dividends. So these are companies with high dividend yields. I mean, you could have a blend of both, but if you want to just really break it down, you have growth stocks and value stocks. So high dividend yields, which is, I mean, they return most of their profits to their customers. Solid companies, good management as well, and low in terms of pricing of the stock. They actually have low price to earnings ratio. Basically mean relative to their earnings, their price is low.
Okay.
The reverse occurs or is the case for growth stocks. So why people will pay more for a stock is because they're looking at the future. That in the future, this company is going to make a lot more. I mean, so look at an Amazon or a Tesla, for example. Tesla is selling at maybe over 50 times its sales in terms of price. And earnings is a lot more multiples than that. But people are paying that for the stock because they think Tesla operates in an electric vehicle company, which is going to be the future. Yeah, exactly. Solar energy as well. It's looking at space travel, commercializing space travel. So these are really futuristic things. And that's why people are willing to pay a lot
because they know
because they feel in the future that price will match up with the valuation in the future. So basically, that's what you have. So in terms of picking good stocks, just look for highly profitable stocks with good profitability history and maybe consider dividends as well. For getting exposure to real estate, the best way I would suggest and which really makes it easily accessible for retail investors is through REITs, real estate investment trusts. So we have a number
yes, we do in
on
Nigeria.
the exchange. Yes. So you might just want to invest in those. What that does for you is personally now, where we are right now, probably we can't afford maybe a house in Banana Island, a shopping mall in Falo Mall. I mean, so these REITs, they have those investments and they get returns from rents and sometimes from flipping these properties. And then that's what's distributed to the unit holders. So that's how they operate. So you are getting exposure to the real estate sector, even with your 100,000 or your 50,000 or your 1 million, whatever the case is. So that's how you get exposure. And the last one for foreign securities. I mean, there are so many apps that you can use right now that gives you access, but you have to know what you're doing. Anytime you are going beyond when you start considering two currencies,
you have to be very careful.
Yes, a risk. Another risk is automatically introduced. So you have to know what you're doing but there are quite a number of apps that you can use to achieve that.
All right. So to me, because we have so many questions, I would want us to keep our answers short so that at least we can attend to, and our time is fast spent.
All right.
Okay. So let's just move on. We have another question from Aret. She's asking, can you explain balance strategy fund? When a fund is called balance strategy, what does that mean?
Okay, so simply it just means it gives you exposure to both fixed income securities and equities. So it tries to balance, diversify the portfolio and gives you, I mean, we're talking about getting hedge against inflation. So if you invest in such a portfolio or such a fund, so you're going to have, so the fixed income part will give you stability, gives you security, preservation of your capital, while the equity part will give you capital appreciation, exposure. So that's just what it is. Trying to reach that.
Thank you. Let's just move on quickly. Okay, we have another question from Joshua. He says, how much is the minimum for investment in dollar-denominated investments? Are we expected to invest in dollar or in naira? And what is the exchange rate or basis of the determination of the exchange rate if you decide to invest in naira? You understand the question?
Yeah, I do. It's asking minimum investment.
Yeah, minimum investment. Is he supposed to, if he has naira in his account, or what does he do if he wants to invest in a dollar investment, dollar mutual fund, and
how do you determine the exchange rate?
Determine the exchange rate, exactly.
Okay, so I mean, it depends on the investment company. There are some that you can do it as low as $1,000. There are some that you need $100,000. So it's depends on the company offering that particular product. So that's what determines that. I think some are even lower than that in terms of ones that are trying to really capture the retail segment. So that's for that. In terms of how do you fund your investment, it has to be in dollars. So it's a dollar fund. It has to be funded in dollars. So you get the dollars yourself, either by getting from maybe the BDCs, you get you whatever amount in dollars you want to invest, you give them the equivalent, and then you secure the dollars and then transfer or pay it into whichever company's account you're looking at. What determines the exchange rate is whatever it is at the moment. So it's not fixed. So it moves. So whatever it is at the point you decide to invest, that's what determines the exchange rate.
And the same person is asking, what's the average of the dollar mutual funds that we have around? What is the average in the last maybe 1 month?
Okay. I do not have that.
I actually do have an idea. So the dollar denominated mutual funds right now are doing around 5%, 5.5%. If I'm giving an average of like a month or 2 months, yes. So you can just contact, like we said, an investment management company that could help you with these investments. The equity mutual fund that he mentioned, dollar mutual funds. Yes. Okay. So we have another question. So someone is asking, what are mutual funds? You've been saying a lot about mutual funds. What is the definition of mutual funds?
Okay, I'm just going to explain it and not really give definitions.
Yeah.
So, imagine we both want to invest in a number of companies.
Okay.
So, want to invest in, let's say, the Nigeria Stock Exchange, for example, maybe all the different indices there. And but we do not have enough that will make a significant impact in terms of units per share for all those companies. So we pull funds together, and then the investment management company or the fund manager pulls funds from different participants together, and then makes purchases in those. So it's called a collective investment scheme.
Yes.
So different people, all of you just put your money in the same pot, then I, as the fund manager, I invest it in a particular. If so, you could have it for that's a similar concept for the real estate investment trust.
Yes.
You can have it for the money markets, for the equity. So if it's okay, money market fund, for example, we'll put funds together, invest in different commercial papers, invest in treasury bills, and when it was acceptable, invest in OMO bills as well.
Yeah.
So that's what a money market mutual fund is. The same thing can be extrapolated to fixed income or bonds. So I invest in the federal government bonds, corporate bonds. So that's what that is. And then for equities, you're investing in different equities. So that's basically what it is.
Okay, thank you so much. All right, I think. Okay, let me just check. Okay, so I saw a question. Customer was asking, do we have what investments are available for ethical investing? When someone wants to be involved in ethical investing, what investments are available for?
Okay, so ethical investing, basically these are investments for people that have reservations about how a company makes their money.
Okay.
So it could be based on religious grounds or for other reasons. So for example, tobacco companies, for example, you could maybe your religion is against tobacco consumption or alcohol. So that kind of fund, that's what the whole ethical concept is about. Or if you broaden the concept, maybe your company, the way your company does business, leaves too much carbon footprint.
Okay.
And then you are conscious about the environment. You do not want. You think there's really global warming. You think we are really hurting the planet. So you don't want to invest in companies that operate in such a way that affects the environment, so to speak. So the people that are looking for green investments. So that's basically what ethical fund is. And that same concept can be broadened to ESG. That's environmental, social, and governmental ESG funds.
Yeah.
So there are funds in Nigeria offered by different companies. Even I think we also have something like that. Yeah. So basically, it's going to limit their investments to companies that you feel comfortable with.
Yes.
It
has biases.
Yes. So you are biased against a particular thing or the other. So those are the funds that make sure that they only invest in things that align with your personality or your goals or whatever the case is.
Okay. I think. Okay, so we have a question asking us from Shola. What types of investments do you have in Quantum Zenith Assets? management.
That's a
So I think
question.
so I'll just take that. So we have four mutual funds right now. We have the Zenith Equity Fund. So like we already said, this invests in equities, different equities on the Nigerian Stock Exchange. And then we have the Zenith Ethical Fund, which is also, so back to the equities, we're working on now making it the Zenith Balance Strategy Fund, where it would invest in both fixed income and equities. And then we have the Ethical Fund. That one is what he just explained right now, that has biases. So if you don't want to be invested in a tobacco company, for instance, the Zenith Ethical Fund takes care of that bias for you. Then we have the Zenith Income Fund. The Zenith Income Fund is the fixed income investment that we have. So that one invests in Nigerian bonds and corporate bonds. So that's the Zenith Income Fund. And lastly, we have the Zenith Money Market Fund. Zenith Money Market Fund invests in treasury bills, commercial papers, fixed deposits. Now, because they are all mutual funds, so they are pretty retail. The startup fee is 10,000 naira. And then depending on the investments, they have different tenors. But because they are retail, they embrace every and any investor. So those are the products that we have right now for our investors. I think that takes care of, I think whose question? Shola's question, yes. So let me just make sure that we don't have any other questions coming in. Okay. All right. I think we've answered all the questions, left questions we have here. All right.
I mean, if more questions, people have more questions afterwards.
Yes, so please feel free. For any reason you have any questions that maybe we have not even talked about at all, please feel free to reach out to us via the email address that sent you the registration. Also, you can drop questions on our YouTube channel, on our Instagram channel as well. Thank you so much, everyone. I just checked the time now, it's already 11:30. We've been on it for 1 hour, 30 minutes. So thank you so much, everyone. Thank you for joining in. We'll still have more webinars coming up this year, and we'll be sure to send you the links to those webinars. Again, thank you very much, and thank you for tuning in as well. Have a beautiful day. Thank you.
All right. Bye, everyone.
Bye.